Moody's just cut their outlook for the US to negative, citing political polarization and deficits as the two main reasons. So obviously we have that budget talk coming up, and we'll see the government probably go into shutdown over the next couple weeks if we can't get a solution there. And in this video, I will go through the other main reasons why Moody's is seeing this downgrade, why they are downgrading the United States. And then also at the end of the video, I will give you a statistical study showing the average return for stocks in reaction to a downgrade from a major credit rating agency. So stay tuned for that. That'll be the last thing I cover in this video. But just to kind of update you in the most recent news. So here was a quote from the rating agency. So they say, in the context of higher interest rates without effective fiscal policy measures to reduce government spending or increase revenues, Moody's expects the U.S. fiscal deficits will remain very large. Significantly weakening debt affordability is a big concern as well. And then the rating agency also said continued political polarization within the U.S. Congress raises the risk that successive governments will not be able to reach consensus on a fiscal plan to show the decline in debt affordability. While the statement by Moody's maintains the United States AAA rating, we disagree with the shift to a negative outlook. That was a quote from the Deputy Secretary of Treasury. So obviously the Treasury doesn't agree with this, right? They're kind of fighting back on it. So that's not shocking. That happened actually the first time this had all happened in 2011, off the top of my head. Funny enough, S&P Global was actually sued in the coming years for like $5 billion for something unrelated. So government does not like this when credit agencies kind of talk poorly about the U.S. But when we take a look under the hood, you can't really blame Moody's here. And one thing that they had noted was too much spending, right? And we can see that here with the government current expenditures. So this kind of shows you what the government spends each year. And we can see here that in 2019, the government was spending roughly $4.6 trillion. In 2020, obviously that spiked. In 2020, we had about 8.8 trillion. And then, in 2020, we had about 6 trillion. And now we're up about 6.3 trillion. So we're seeing somewhat of a jump in terms of fiscal spending. Obviously, spending more money and getting less money in, or even the same amount of money in taxes, that kind of exacerbates this debt issue. So unfortunately, current expenditures have been going the wrong way for the United States, and that's really what Moody's is citing. And then to give you a couple more examples here, so they also cited higher debt payments, and the US is paying the highest they have ever paid in terms of debt. So we're on the hook for almost $1 trillion in interest rate payments, or in interest payments on our debt. So we're not even, paying it off. We're just paying the interest on our debt, and it's $1 trillion a year. That's insane. And when you compare that to the US economy and GDP, really, it's pretty scary. So GDP to debt is actually at 129%. We're at all-time highs in terms of debt to GDP. So it's never been, there's never been more debt relative to economic activity than there has been in the United States history. So debt to GDP at all-time highs. That's very unfortunate. That's basically a kind of huge issue for the U.S. And you really can't blame Moody's for acknowledging this, right? It's just really acknowledging reality. And then if we take a look at the deficit here, so the U.S. had about a $3.1 trillion deficit. This is year by year in 2020. And this is even down from 2010. We had about 1.4 trillion deficit. In 2015, we had about half a trillion. And currently, we're at 1.6 trillion, 1.7 roughly. And we have come down from 2022. At least in 2022, we were about 1.37 trillion. And now we're only about 1.7 trillion. This deficit, unfortunately, has gotten worse, which is very unfortunate to see. Don't love to see that. And then obviously in 2000, that was the last time that we were actually had a surplus, meaning the treasury was making money, right? The US economy was bringing in money. They had more revenue in taxes than money that they spent. That was in 2000 was the last time that happened. Or actually 2001. So, it's been over 20 years since the government has, kind of turned a profit, if you will. And it doesn't take a PhD to understand that that's a unsustainable situation, right? The U.S. is going to have to get some money into their treasury, right? You can't just continue to lose money forever. It doesn't work that way. And like I said, Moody's is really just acknowledging reality, and I really kind of appreciate the call out, because maybe now we'll see some policy action from Congress, right? Like I said, we have that government shutdown honestly looks likely, and it's approaching pretty quick. There's just a week left to kind of avoid this government shutdown. We have House Speaker Mike Johnson is expected to release his budget for the year this day today. So on Saturday, the 11th, we're expected to get a budget from Mike Johnson here, which is the new Speaker of the House, newly appointed. So hopefully that is kind of good enough for his Democratic cohorts, or counterparts, I should say. So hopefully they can kind of figure something out and come to an agreement, because if you don't come to an agreement and we see a government shutdown, that really just signals more weakness, and we could see other downgrades from other firms, right? So we could see Fitch jump in there, we could see other firms jump in there, or actually Fitch actually already has the US as a downgrade, but we could see other ratings companies come in and downgrade US debt, which would be very unfortunate. And this isn't even a quote unquote downgrade of debt. It's just a downgrade of the outlook of the US economy. So what could happen is they could actually come in and downgrade the debt, which a bunch of credit agencies have done in the past. So this really isn't that bad right now. Unfortunately, it's been a precursor to actually seeing a downgrade of US debt. Like I said, this is just a downgrade of basically the US outlook for the economy. It's not a downgrade of debt necessarily. Take a look at how historically the stock market has reacted to downgrades in the past. So the average return is negative about 0.1% on kind of that initial news. And then over the next 5 days, it's actually positive 0.1. Obviously, the market has an upside bias. The market's up more than it is down generally. So that's probably what it is there. But in history, it actually hasn't been too bad. I think it's really all about context, right? So what's included in the study is in 2011, in April on the 18th, S&P issued a negative outlook on the U.S., but kept that AAA gold standard rating for U.S. debt. Unfortunately, a couple months later, in August, we saw the first ever downgrade of U.S. debt, and U.S. debt went to AA from AAA. And stocks fell 1.4% in one day, and they were lower over the next 5 days. So that it's this initial news isn't a huge deal in itself. It's just it implies that we could see a real downgrade of U.S. debt, right? Not just the U.S. economy, and that would be concerning, because then investors would require a higher interest rate to buy our bonds, which would really be a horrible thing for the U.S. economy, be a horrible thing for U.S. businesses. So really hoping that doesn't happen. And then in 2012, I'll just go through each of these cases here. Egan-Jones downgraded the U.S. They downgraded the debt, and that just really is a small firm, right? So it didn't really make much of an impact. And then in 2013, we had a Fitch warning of a downgrade. They didn't actually do anything, luckily. So if anything, that's somewhat encouraging here, right? We're not seeing Moody's actually downgrade the U.S., right? We're just seeing basically a warning, if you will, although they're downgrading the outlook of course. So the Fitch warning did pushed the market lower about 0.5% that day. And then the Dagon Global Credit downgraded the U.S. as well on 10/17/2013. But there was really no reaction to that just because it's such a small firm. And stocks actually were up on that day, and they were actually up over the next 5 days. So it wasn't a huge deal for the market. I really think, in COVID, it was common for governments to be questioned in terms of their fiscal spending because they were spending so much. The economy was so weak for a short period of time. But I think investors kind of looked past that one because it was COVID, right? It wasn't like the economy was in a horrible spot and the economy fell off a cliff. No, it was just COVID, and stocks and the economy, businesses all were hurting. And it was really just a short term drop in economic activity. It wasn't anything systemic under the hood that's having major issues, like kind of what Moody's is talking about now, right? So unfortunately, it's a different reason here. And then Fitch in August downgraded the U.S. in 2023. So on that downgrade, stocks were actually roughly flat on the day as well. So nothing really came out of that one. So overall, it's actually not as bad of a reaction as you would think. Like I said, though, each situation is different. Like the most extreme case is that first ever downgrade of U.S. debt that we saw in August in 2011. That was obviously a major down day. We had 1.5% roughly down for the S&P 500. So every situation is different. In this situation, I would say it's a lot more extreme because Moody's is giving firm reasons that have a ton of logic. Like these aren't like, this isn't saying, oh well, COVID is going to hurt the economy, so the U.S. will probably suffer. This is an issue where it's like, no, this is U.S. specific. This the debt to GDP is at all-time highs, right? We're spending like drunken sailors. The government can't get their act together. The Congress can't pass a gosh darn budget bill. So it's just, there's structural issues that Moody's noted that are extremely valid. So what I'm hoping that this doesn't play out as bad as we could see it. And it's also worth noting that we have this conflict roaring on, right? Still in Ukraine, and now the government is really hyped up, or I shouldn't say hyped up, but is likely to spend hundreds of billions of dollars to fight these wars, even if we don't have boots on the ground. Economically, we're pretty much fighting in these wars. And Biden just asked Congress for $106 billion, including $85 billion for Ukraine and Israel. And I'll kind of break down how this works. This was a first offer, and how this works is Democrats always like to spend more typically than Republicans. So Democrats will always pretty much overshoot, what they're looking to actually get. Like there is no shot that Biden actually thinks he's going to get 106 billion. He just puts that out as kind of a first offer, and then the congressmen, the Republican congressmen in the House will come in and undercut that, and then they'll probably meet somewhere in the middle, I would assume. But just to give you a breakdown of what this actually goes to, so roughly 61 billion would go to assisting Ukraine. And then Israel would receive 14 billion to fight Hamas. Another 10 billion would be dedicated to the humanitarian assistance in Ukraine, Israel, and the Gaza Strip. So a lot of that would go to Hamas, weirdly. I shouldn't say weirdly, but just like interesting kind of sending to both sides of the conflict. Not saying it's wrong or right. This isn't a political channel at all, but I found that interesting. And then nearly 7.5 billion would be spent on countering China and securing the Indo-Pacific region, including Taiwan. So they're preemptively sending money to Taiwan. They're not even being attacked yet, although China is threatening, and they have for years now, and they've really ramped it up over the past couple months with military demonstrations. They're flying planes over Taiwan. They have their military ships sailing around Taiwan. So it's like, I understand where that comes from. It's not made up. And then 13.5 billion would be dedicated to securing the U.S. border with Mexico, countering the smuggling of fentanyl. And this is kind of a piece in there for the Republicans, if you will. So that's kind of a sweetener in there. I guarantee you that's a sweetener in there to help get this bill passed, right? You put a piece in there to make the Republicans happy because that's kind of their issue, you know. Like I said, not a political channel, just kind of acknowledging reality here. And then included with those proposed expenditures is more than 50 billion for U.S. defense industrial base to ensure military readiness. So, you know, a good chunk of this, you know, roughly $63 billion goes to the U.S. in this. This isn't just a spending bill for other countries. This is, you know, a good amount of spending for the U.S. Like I said, about 14 billion for the border and about 50 billion for U.S. defense readiness. So super interesting times we live in. The U.S. economy is definitely justifiably being criticized right now. So I really tip my hat to Moody's, honestly, because it's better to acknowledge reality now than have some major issue down the line. So I really do appreciate Moody's kind of calling this out and saying, hey, you guys seriously need to take this, you know, government shutdown as serious as you possibly can, and it really can't happen, right? So that's kind of what Moody's is signaling to me, because this is all very timely, right? The government could shut down next week. So spending bill, this puts more pressure on that spending bill to, you know, get solved and agreed upon. So I hope that plays out well, and we see some bipartisan support for once. I think the country is starving for it. So hoping that gets passed. We'll see how that develops throughout the weekend. I'll likely put out another video about it if we get any major developments. So make sure you like this video just to help out the channel, and make sure you subscribe as well to, you know, watch that next upcoming video. So with that being said, I appreciate you watching, and I'll see you here next time.